Welcome everyone. Thank you very much for being here. My name is Adil Najam. I'm the director of the Frederick Pardee Center for the Study of the Longer Range Future. It's wonderful to see again a full house. Thank you for being here. To the first of our seminars this semester, we've taken a little late start this semester, but we're going to catch up for it this month and later. Our next seminar, just to give you a little sense of what's coming up for those of you who are regular visitors here, we have our next seminar in this series happening at the end of the month on the 23rd of October. Which is called Need, Greed, and a Sustainable Future. And this is going to be different in the sense that it's a book talk by the author of this new book called Treasures of the Earth, Salim Ali from the University of Vermont, who will be here with us for that. And that will be on the 23rd of October, which is also a Friday. We had just about 10 days ago, right here, a wonderful workshop on an interesting question led by Professor Susan Eckstein of the Department of Sociology and a fellow here at the center, and that was on the impact that migrants have on the countries they leave behind. So we sort of overturned the question and said, not just what is their impact on the countries they adopt, but how do they impact the countries that they left behind. And this is a book project, and we hope to have a book coming out of that soon. We also have later this month another project, another workshop, which is on managing complexity in higher education in developing countries, and it looks at the state of higher education in developing countries, and the hope there is to come up with actually mathematical and sociological models of how that operates. So all of that to say that we have a busy calendar, and we hope that you will join us for these and other events that will keep happening. We've also recently published a new Pardee paper, the latest in our series, now number 6, which is called Global Aging, Emerging Challenges by Alexandra Crampton. Alexandra was a postdoc researcher here at the center and is now a faculty member at Marquette. So we're very, very delighted to have that paper at a very interesting time, and it looks at the issue of aging, but also in terms of what is happening to aging in developing countries. And our most recent policy brief is on the future of malaria in Africa. So again, all of that to say that we've had a busy time. The last thing on here that I do want to mention, since this is the first time we are meeting since the summer, we had a wonderful time this summer with our first batch of Pardee Center Summer Fellows, who were here with us all through the summer and worked on all sorts of issues, and we hope to have that program again next summer. I mentioned that particularly if you have students or are a student yourself or know others who are interested in this, we will be having the Summer Fellows program this summer again for graduate students here at Boston University, and we hope to have information of that available on the web towards the end of this year or very early next year. But just to keep that in your mind. So sorry for that long diatribe, but I wanted to catch up on the news after the summer. We are delighted today to have a wonderful panel sitting right here with us of 3 very, very eminent and very, very interesting scholars who we want to talk to about the topic today, which is global development beyond the financial crisis. And what we mean beyond the financial crisis is both the longer term implications of this, but also I'm hoping the implications of not just the financial crisis, but what we are doing in response to the financial crisis. Because while we are very, very busy in trying to figure out what to do about this, whatever we do about this will have long-term impacts. It has already long-term impacts on the IMF, already a changed institutions in terms of the amounts of capital it has. It has long-term impacts on international development, on international institutions. So all of these changes which we are making will stay with us. And so one of the things I'm hoping, apart from everything else they talk about, is how might that impact global development, and particularly for developing countries. We have with us, and we'll go in this order, Dr. Shahrukh Rafi Khan, who's joined us from Mount Holyoke, former head of the Sustainable Development Policy Institute in Pakistan, and it's wonderful to have him here. I won't go into the detailed introduction. They are on our website. I hope you'll visit it there. Welcome, Shahrukh, and we will start with you in just a minute. Then he will be followed by Professor William William Grimes. Bill is a colleague at the Department of International Relations, someone who has looked at the international world of finance for a long time, particularly in the context of East Asia and Japan. And he is also the director of the Boston University Center for the Study of Asia, which is a co-sponsor of the event today. And we are delighted to welcome our third panelist, which is Professor Michael Walton, who joins us from the Kennedy School at Harvard. And we are delighted to have you here because we did contact you late and we were very glad that you were able to join us. Michael Walton, apart from teaching at Kennedy, has been involved in many world development reports of the World Bank, including being the lead on two of them, which was what, 2006 and 5? 95. So we're delighted to have all three of them. The format, as always, is going to be we will ask each of them to speak briefly, maybe around 10 minutes, to set up some opening thoughts, and then we will open it up for what I'm sure will be an inspired and inspiring Q&A. Shahrukh, all yours.
So, very pleased to be here. Thank you, Adil. And the topic that Adil mentioned about a week ago that I should reflect on and make some comments on are the long-range impacts of the outcome of the financial and economic crisis, looking at it from the perspective of developing countries, the fallout for economic development. I'll be looking at it quite quickly from the perspective of financial issues, impacts on the real sector, and then on global governance. All of these have important implications for the medium term and the long term. And I will do so in the context of a debate that is going on about alternative development models. So that's now just a couple of minutes on terms. I prefer not to use the word developing. I don't use the word developing countries because often that's not the case. I prefer a more neutral term like low-income countries, middle and high-income countries. Those are the terms that I will use. I also ascribe to the definition of development, which is a little different from that has been accepted in the literature. The definition that Sen uses in terms of human freedoms, or the definition used by the Human Development Reports in terms of extending a range of choices. I'm more comfortable with the definition that's now coming into use, which looks at development as a structural transformation, not structural adjustment, but a structural transformation such that countries have an endogenous technological capacity. If that happens, then the outcomes can be human freedom, and they can be inclusive development. But without that endogenous technological and production capacity, the other things really aren't possible. And one of my colleagues calls it Band-Aid development, because if you're constantly reliant on a handout, then it doesn't seem that is endogenous development. Now, for it to be endogenous development, the focus may need to be on increasing returns activities. A lot of the primary sector activities are constant returns. They don't create wealth as such. So the focus, and in that sense, then manufacturing in particular needs to be a very central focus of this project. This alternative model that I'm talking about, it's one of several competing models. This one has been conceptualized based on the experience of East and Southeast Asian economies by economists like Ha-Joon Chang, Danny Roderick, Robert Wade, Alice Amsden. These are the people who've of late done the conceptualization of an alternative model, and that is what I'm really referring to here. So this is in juxtaposition to the liberal model of deregulation and privatization and and liberalization of various kinds. Now, on to impacts. I said I'll talk about the financial sector, then the real sector, and then global governance. So, in terms of finance, how do we see things moving in the medium term? Well, it seems that for at least the medium term, they're going to try and put the genie back in the bottle. The genie here being the high-flying financial sector institutions. I think that most people have recognized that given the way incentives work, given that capital gets concentrated, they exercise an inordinate amount of political leverage and get the kinds of deregulations that they need to play on markets that's unsafe for the rest of society. So this has negative externalities, and at least for a while we'll see an effort to contain them. So we might see high capital requirements, we might see an insistence on low leverage, not taking as much risk. We might see that firewalls will once again be put between the financial investment and banking. And if this does happen, if these prudential regulations do come about, which it is likely that they will, then I foresee that there will be capital scarcity in the medium term, a fair degree of capital scarcity. And I also anticipate that this capital scarcity will affect, in particular, low-income countries. One is already seeing a move among the emerging economies, the middle-income countries, a movement to address capital scarcity issues. This started in 1997 after the East Asian contagion. The ASEAN countries already talked about an Asian monetary fund in 1997. This was scuttled because the Treasury was not very happy about it. Neither was the IMF. It was in direct competition. But the remanifestation of this concept, it didn't die. It was just reincarnated. It's come back again. It's taken a slightly different shape. And 20% of the capital will be funded through the IMF. So in a sense, it's less in juxtaposition to the IMF, more friendly. But one of the things that's happened is that China is now much more confident than it was before. A lot more self-confidence, a lot less scared that this is an attempt at Japanese domination, financial domination. So there's more comfort level, it seems. But in any case, Far Eastern Economic Review, while they were around, May 4th, 2008, reported that the 10 ASEAN members put together about 20 billion, and the plus 3, which is China, Japan, and Korea, put up 80 billion. So they have a fund now of 80 billion. Latin America also has, of late, September 28, 2009, agreed to a Bank of the South. This will also address capital needs of emerging economies. This is not just Venezuela. Brazil and Argentina have signed on, and as have some of the other important countries like Uruguay, Paraguay, and so this is, and Venezuela, of course, talks about creating a South-South bank, which would include sub-Saharan Africa. This one would have to wait and see. Now, what countries had been doing so far was that they had been building up reserves, their own reserves, and they had been paying back funds more rapidly than they might have even needed to in terms of the way funds were contracted with the IMF and the World Bank. What happened effectively was that the portfolio of the IMF started to shrink a great deal. And you might recall about a year ago, people were literally talking about, is this an organization in search of a mission? Do they really have anything to do? Because, and as their portfolio shrunk, a lot of the staff started to be laid off. They had given voluntary retirements to almost 1/3 of the staff. And as an emergency measure, the IMF was seeking permission to sell some of their gold reserves so that they could stay solvent. So one of the organizations that has gained the most from the fallout of this crisis has been the fund, in the sense that it has been resuscitated. It's got almost $500 billion because the fallout on low-income countries it was agreed will be channelized. The help will be channelized to the IMF. So they now really. So what is at the heart of this was this tension between different development models, the liberalizing, deregulation, privatization model that the fund advocates relative to an East Asian model with industrial policy and a much larger role for the state, which is a good time to turn to the real sector and to see what has happened in terms of the fallout of this crisis. And some things that I should mention, there has been an important stimulus package, $787 billion. There's been directed intervention, a kind of an industrial policy, bailing out General Motors, Chrysler. This was something that was really quite frowned upon in the mainstream among classical economics, but it's there. Buy local provisions. All of these policies for the real sector is, in a sense, a blow to the neoliberal model. The question then remains, do the low-income countries have a policy space to pursue an alternative? And this is something Kevin Gallinger, who's sitting here, has done quite a bit of work on. Let me then turn to global economic governance as it is evolving. The old institutions are still going to be there. A strengthened IMF, perhaps, maybe not as strong as it wants to be. One of the things we noticed in Ankara and in Istanbul is a very aggressive move for the IMF to become kind of a global bank of last resort. Surprisingly, this was opposed by Germany. So it's not clear how they will come out of these meetings in Istanbul, whether this role that they want, a much more prominent role, will be even conceded to by other high-income countries. But that is what they're striving for. An interesting move is this switch from G8, G7/8 to G20. Personally, I think it's a brilliant move. You had the BRIC countries actually fairly hostile in their rhetoric. If you see what they talked about in the side meeting in Istanbul, they seem to have been completely co-opted. They're quite comfortable with the existing world order. They talk about maybe instead of 5% of IMF votes, maybe you should change it to 7%. That won't happen. They'll still get 5%. But they're not unhappy with that. And they're talking about a more speedy conclusion of the Doha round. And we can think about how Korea behaved when it entered the OECD. And Ha-Joon Chang talked about Korea's role. And essentially what he said is Korea's kicking away the ladder. It's now part of the club. Korea didn't do very much in terms of letting other low-income countries follow the model that it did itself for its catch-up growth. And to think that the other countries of the G20 will do that, it's unlikely. The extended G20 will look to the extended G20. It's not very likely that they will address the needs of other low-income countries. So they'll have to do it themselves. As far as the IMF is concerned, there still seemed fair degree of hostility to them. You probably heard of the riots. Even Strauss-Kahn got a shoe thrown at him. The aim was not as good as the aim of the person who threw a shoe at President Bush, but in any case, it was a symbolic gesture. So let me just say one last thing. I've been doing some research on this issue. I looked at, I excluded transition economies and I excluded low-income countries with population less than 5 million. I wanted to see what was happening to manufacturing capacity of the other 80 countries. Between 1980 and 94, the 60-80 period is different. I won't get into those details. And then after the Uruguay round, 1995 to 2007. Of these, 2/3 of these 80 non-high-income economies show either stable or declining manufacturing capacity. So they have their work cut out for them. Thank you.
Thank you. Thank you very much, Shar. Thank you for setting up the problematique for us, and I think it's very important. At least for me, it was as I was listening to you to realize that when we talk of financial institutions in the context of the current crisis, we nearly always think of AIG or Citibank or Bear Stearns. But for a lot of people in countries in the world, the financial institutions that matter are as much the IMF or the G8, G20, and that has really crept up on us without anyone noticing just what happened there. And these are changes that will remain with us for the longer term. So thank you for setting that up. Let me move directly to Bill to pick up from there.
Okay, so I'm going to, I think, start from a premise which is similar among us, that when we're talking about finance, we're not talking about financial institutions and what products you're talking about, but what is the process by which you move the savings from the ultimate owners of the savings to the users who can use it most effectively? And that's a question, in other words, when we think of the functions of the financial system, of efficiency, but also of stability. And that's been one of the, I think, one of the big rubs of the problem of financial innovation. So what I'm going to do is, I know that this is a center for the study of the longer range future. I'm going to start with the shorter range past, move on to the very short range present, and then try to talk a little bit about what I understand to be the medium term future, with apologies to my sponsor. So when I talk about the short term past, it's not, I'm not a historian, don't worry. And I will say I am going to focus on the long-term effects of the global financial crisis on East Asia. So when we talk about the past, what we are talking about is post-1997. The past starts, in essence, with the Asian financial crisis of 1997 to 1998. And the only way in which we can understand the way in which the countries of East Asia are going to respond to the current crisis and are responding to the current crisis is to put it in the context of the response last time and also the institutions that were created to deal with the problems of last time. So let's quickly run over last time, and I will try to be very quick. So there are short-term effects I think we're all very familiar with. There was severe economic dislocation and political dislocation or political issues ranging from political dislocation to what my Indonesian friends in the front row will understand to have been political mayhem. And at the time, in terms of how we understand the longer term, economically speaking, there was a lot of speculation about alternative forms of capitalism. What models should we be using, the world, East Asia, be using to prevent this from ever happening again? What did we get wrong? And so there was a great deal of discussion about the proper role of capital controls, the proper role of regional stability organizations, in some way insulating this region and the individual economies from the vicissitudes of global financial fundamentalism, as some people called it, or global financial markets. Now in the medium term, we get a series of different effects. So the first thing to note is that with the exception of Indonesia, you basically get V-shaped recoveries. Arguably in Malaysia, you get a U-shaped recovery. But everybody more, and Indonesia, I think, gets a U-shaped recovery. It's just a kind of a long bottom part due to the political problems. But you get V-shaped recoveries and the recovery also of political stability in a way that I think many people were surprised at or would be surprised at if we remembered what we were thinking 12 years ago. We see the reintegration of all of East Asia into the global financial system and the global financial architecture. And there's 2 points I want to make briefly in here. One is that for all the talk of capital controls and the championing of the Malaysian model or the Chinese model, every single one of the ASEAN plus 3 financial systems is more open today than it was 12 years ago, with the exception possibly of Thailand. They are open. They are open to the world. East Asia is part of the global financial system. And it is part of the global financial architecture as well. you were mentioning, for example, the Chiang Mai Initiative, but when we actually look at the Chiang Mai Initiative is set up very clearly as a supplementary mechanism to the IMF. There is a lot of talk about how this is going to change, that the multilateralization that is to come about in December will create the Asian Monetary Fund as first suggested in 1997. Having had the opportunity to talk with people who actually have the whip hand on this a couple of months ago, in other words, the Japanese Ministry of Finance, I can assure you that is not going to be the case. This is going to remain a supplement to the IMF. There will be no new conditions and surveillance criteria that differ from the IMF. Openness will continue to be encouraged, but, and I think this is a very important but, in the context of two important changes. One is a reaffirmation of the need to look at the problem of sequencing, which was very badly neglected in the early 1990s. And the context of the IMF has changed. This is not the IMF of 1997. The extent was that the new facility, whose name I always forget, that allows us, that essentially is creating what was believed to be what we were trying to create with the contingent credit line, is in play, and the IMF has acted very differently in this crisis. My Indonesian friends will probably be able to tell me the exact number, but I remember the number of conditions placed on the standby agreement with Indonesia at 133. It might have been 138. It was somewhere in that range. Conditions for getting IMF money. How many conditions did Iceland get? How many conditions do any of these countries get? Well, they shouldn't get 138 conditions. I think everybody's learned something. Another medium-term effect is looking at financial regionalism. As I said, there is the emergence of this thing called the Chiang Mai Initiative, which is the follow-on to the Asian Monetary Fund proposal. But it remains very, very much a part of the global financial infrastructure. Capital controls have been thrown to the wayside as the ASEAN plus 3 countries have sought to develop their domestic bond markets in order to reduce their reliance on dollar markets. But in order to reduce the reliance on dollar markets, they have to actually liberalize at a greater length. Nobody is sure how to square this circle. And we've had some discussion of currency cooperation, which I'm happy to talk about later, but for here, let me summarize by saying it's totally unrealistic. Now, in terms of this talk, I think the key thing is development effects. And what I would say is that the sort of medium-term effects of the Asian financial crisis on the ASEAN plus 3 countries has been minimal in terms of what I would think of as development strategy. We have had the reappearance, and in fact, in some ways, the strengthening of the bet on rapid export-oriented industrializing growth in order to lift all boats, which has been really wonderful, really successful in many ways, although, of course, we have this problem of imbalances that arises. The present, I'm going to go very quickly on this, and just note that there's much that we can break this up into different categories. First, financial effects on East Asia. No direct effects to speak of. There is not a single country that has anything like the German Landesbank problem in East Asia. There's not a single major East Asian financial institution that has gone under as a result of direct exposure to the problems of global finance, which turns out to actually mean US-European finance. We have seen no currency crises. These things have been made possible by a variety of policies, both local and global, but much of this has basically been at a country level. Currency flexibility. There's no hard targets to hit. Massive currency reserves, which frankly, from an economic point of view, is a very bad lesson of the last crisis. It's a poor use of resources. It contributes to some of the problems of confidence and the excess liquidity in the US market. But I'll tell you, when you're Malaysia and you run into a decline in your growth of going from 5-6% positive to 6-7% negative, the ability to simply say, okay, we are going to have a fiscal stimulus at a rate of 3-4% of GDP is pretty nice. And that's actually going to be one of the mistaken lessons of this crisis as well, and something that I think we should all be worried about. And we see that there seems to be on the financial end a spur to regionalism. The expansion of the Chiang Mai initiative from $80 billion to $120 billion, to the appearance, not the reality, but the appearance of something like an autonomous regional organization that looks like an Asian monetary fund. All of these things are now back in play. On the economic side, we do see a massive slowdown in growth due to the real economy channels, and I think both of the other speakers can speak much better than I am. And as I said, large-scale fiscal stimulus in every single one of the export-dependent countries of East Asia, down to Vietnam. Every single one of them has had a substantial fiscal stimulus ranging from 1-2% of GDP all the way up to 12-13%. Now, the 12-13% is over a couple of years. That's China. But still, it's big, right? And this has been possible because of some of the insurance that they bought at very high cost in the form of foreign exchange reserves. And as we all know, East Asia is coming out of this crisis faster and stronger than anyone else. And that's nice for the present and for the short term. Finally, in terms of development effects in East Asia, as in the first crisis, the last crisis, I should say, of course, the poor get hit the hardest. The poor always get hit the hardest. Of course, exporters get hit the most directly, but the poor have less, less means to make it through. On the bright side, the worst effects have been cushioned by the development of social safety nets, by a new, I think, international consensus that social safety net is actually something that you should be able to borrow money from. If you get an IMF plan, you should be putting more money at the poor and creating means by which you cushion the impacts of international and other economic crises, and an emphasis on bringing back growth. So in the medium term, which is the term that I usually deal with, I'm optimistic. Now, I know I have to talk about the long term, and I'm at 10 minutes, and Professor Najam told me 10 to 12 minutes, which as an academic I understand to mean 15 minutes. But I will try to knock this one off in 3 minutes, largely by addressing a series of questions. So the first question that I think we need to think about for the long term is, can East Asia achieve balanced growth? And this is really a China question. Can we shift to a system in which the East Asian countries are not reliant on purchasing American debt? I mean, I'm happy to give anybody who wants it useless paper money in response for useful things. But in the long run, you have the sustainability problem. And can China make that shift towards more demand-oriented growth? The current fiscal stimulus plan does not necessarily give us any hope for believing that we're having a fundamental change in strategy. The leaders understand it, but we haven't seen it yet. And that the types of policy shifts that would be required in order to pull something like that off are, I think, an immense challenge. Second, is there an alternative to massive defensive foreign reserve accumulation? And this speaks to essentially two questions. One question, which is, what is going to be the future role of the dollar? And the other question of which is, can East Asian regionalism help to stabilize the economies? And the answers are, I think, very, very problematic. And this is, for me, as somebody who's not a development economist, but has spent a lot of time looking at the problem of leadership and order in global and regional financial systems, we have the fundamental problem. Is a dollar decentered world a better world? Can you get the kinds of collective action that you need in a great crisis, which can still arise, we assume, in the absence of that single coordinating body that we call the United States? I was very interested when you mentioned fiscal stimulus. You mentioned the American fiscal stimulus plan. I mean, I'm talking about the East Asians, but when we think, what stopped this crisis? And if we were to say two things about what stopped this crisis, I would say Ben Bernanke and Hank Paulson. They created the crisis, no question. Not those two people personally, necessarily. We, the United States, created this crisis. But in the absence of a single potential lender of last resort, of the US, which is, as Kendall Berger pointed out years ago, the great market for distressed goods, can we create an international order that works better? And that essentially is what people are saying that we're calling for, the Chinese are claiming to be calling for. But I see no very comforting way around this. And I don't think that regionalism creates, even in East Asia, is going to be enough to stabilize. You have significant political challenges, you have significant economic differences, and I know that since we're talking about the future, we're supposed to be hopeful. So let me just say that I think there's nice opportunities for development projects. That's the place to look. Infrastructure funds, cooperative development, public-private institution, investment strategies, and the like can create an opportunity for recycling the surpluses of fortunate savers in East Asia to the needs of the Asian economies. Thank you.
Thank you very much, Bill. Thank you for that wonderful. And you were focused on the future. Times past and times present are both present in times future. I would be intrigued to hear how the others react to your arguments, including on whether Ben Bernanke with his magic cape stopped the crisis. Stop! That's the image I got when you were talking. But I think sort of one of the things that intrigued me when you were talking, and we hopefully might come to this later, is also this notion that you pointed out that out of the Asian crisis, the Asian countries came out all freer economies. And one question that popped in my head is, would out of this global crisis, all of the world come out as a freer world, or whether it will be more protectionist, I don't know. I should also apologize for the noise outside. There is construction going on. I don't know if it's part of the stimulus package or not, but I do know that we have no ability to stop that, but I hope it isn't causing any problems in your hearing our wonderful speakers, the next of whom is Michael Wharton. All yours.
Great. Thank you very much. I want to look at the question of the outlook for the future in terms of two sort of contextual issues. First, in the kind of realm of ideas and the interpretation of capitalism, and the second contextual one has already been referred to. Both of these have been referred to, and that was what did happen in the crisis was a significant push in the short run to the relative rise of Asia, and I would very much include India in that. And my other kind of base these days is very much, point of reference is very much India as opposed to East Asia. But also looking forward, given the international structure of debt, the context is that relative push to the relative rise of Asia is likely to continue. So, first, on the way I'd like to do this, make a few comments on the kind of crisis of capitalism, then outline what you might call an optimistic scenario of moderation and successful transition, and then suggest some reasons why that may not occur. So, on the interpretation, was this a deep crisis of capitalism or a problem in the design of the motor? My own assessment on this, looking in terms of my reading of interpretations in the US and Europe, and my following of the Indian economy, is that this was not a fundamental crisis. This was, if you like, an analog, the contemporary analog to the 30s crisis, or the kind of Keynes's interpretation of the 30s crisis, in that it was a problem of the management of capitalism. And the way I would look at that is that there were really big inadequacies in the management of risk in capitalist societies and in the regulation. These are, and if you like, if I turn for a moment to thinking about India, where the way I see the Indian situation is dynamic capitalism is the only way I can see that there will be the kind of generation of the resources that will support the resolution, that will support India's transition to prosperity. But whether I think of India or whether I think of the US, that could fundamentally fail if there is not the shifts in terms of the way I characterize it is a comprehensive approach to the management of household risks, which is needed both on social reasons and now in democratic societies, even poor democratic societies, for political reasons, and a different approach to the management of risk in the business sector, of which the finance is a central mediator, and allied to that a more complex issue, which I understand much less clearly, the regulation of finance and business. That's where I'm coming from. So, given that, here are three elements of an optimistic medium to long run scenario of what you might call successful moderate transformation. The first would that in rich and poor countries alike, there would be the development of such risk-based mechanisms, and there would be the development of what I think is still missing in terms of a different approach to managing the financial sector. I have two comments on that. One is, I think the fact that almost all financial systems in developing countries, with apologies to Shahrukh or whatever, that including Latin America, did not suffer from the first round toxic asset. But I would say that they lucked out. And they lucked out for different reasons, because in the case of India, it is still a pretty backward financial system and a highly controlled one, and one that is not suitable for the development of broad-based dynamic capitalism, including for small firms. In the case of Latin America, because the financial systems were so badly burnt by all the previous crises that you have excessively risk-averse financial systems. So they didn't take on these assets. So I think if I were thinking of financial designs for the future and what they should be concerned about, I would not relax. If I was a developing country manager, I would say, if I don't get it right, this crisis is our future. It'll be different from the previous emerging market crisis, but that is where the finance is going to go if I do not get the structure of the management of risk, innovation, and regulation right. And first, that's first comment. Second comment, I am, it's not really my deep area of expertise, but I find more persuasive the view that there was a quite remarkable effort in terms of stopping systemic collapse and a global semi-coordinated fiscal stimulus. And that really did, if you like, save the world last year and prevent us all falling into a new Great Depression. But that in terms of whether you call it risk management or regulation, the situation looks still deeply inadequate. That's a big, outstanding agenda. So, first, the optimistic view is you work out how to solve that, and that will be solved. In rich and poor countries alike, you have different mechanisms for complementing capitalist advance. Second, the international corollary of this has already been referred to, in that there would develop international mechanisms for collective risk management, and that the most plausible and the certainly self-promoting candidate for this is a very different role of the IMF with respect to having the resources to provide that collective risk management, and also having the surveillance capacity to be able to, at a minimum, provide the information relevant to stopping asset bubbles before they get out of control. More speculatively, having a role in terms of the management of capital flows. That's a view of, say, Arvind Subramanian. I just don't know about that. But that is on the table and clearly needs to be got into in terms of what are the issues on the agenda for international management of risk. Third issue is that over the coming, I think we're talking a couple of decades, there will be a smooth, if you like, the analog of a soft landing of the multiple transitions that will have to take place in terms of the continued relocation of manufacturing jobs from the US, parts of Europe, to Asia, effectively substituted by shifts into the service economy in these societies, that there will be a smooth transition in terms of what people often talk about the global savings and investment imbalances, with shifting strategies in East Asia and other states in terms of a shift in towards more consumption-based growth. And there will be a smooth transition, if it's necessary, and my instinct it is, in terms of the where savers put their assets, or if you like, what are the dominant reserve currencies in the world and the relative decline of the dollar in that position. So that, would say, is a happy scenario. I want to leave us with a number of reasons why this might not take place. The first has been referred to and relates to the diagnostic frame that important parts of the crisis and the inadequate response to the crisis has been the concentration of political influence in major big banks, in this case, or the analog to that in, say, Mexico or India would not just be in the banking sector, but the big family corporate controls that will influence them with influence over the government. And that has been one of the reasons why there has not been a more effective restructuring of the market structure, leaving a system where, in the US, the banks are more concentrated, more influential, even more too big to fail. Second, that there will, in terms of the international shifts which would underpin a new role for collective risk management, and I'm focusing on that. There are other dimensions of management of the global economy, that there will be a combination of resistance to the relative decline by the US and Europe, which we see in the detail. The 5 and 7% was already mentioned, and the fights over number of seats. But that's the kind of detail of a bigger resistance to those shifts into the structure of influence. And secondly, what I would call a kind of rational mistrust of the behavior of the IMF. And this is the view, I think it is absolutely true, that the IMF behaved very differently. I totally agree with William on this, in this crisis. I think a lot of that resided in the personality of Strauss-Kahn. You've got a powerful intellectual socialist leading a highly hierarchical institution. And the big question is, when he leaves, is the people have commented, has the internal functioning of the institution still, the knee-jerk reaction is what really matters is inflation and cutting deficits. And on the other hand, will the US really be willing to give up its role? Third question, this has also been nicely put on the table, and it's actually outside my area of competence. Is there scope for a countervailing Asian Monetary Fund or whatever we're talking about? And I guess as I've only seen this from the reaction of Indians, that tremendous caution over the difficulties of coordination across countries, tremendous mistrust between India and China, tremendous historical mistrust between China and Japan, big mistrust from at least a bit out of date here, on the rest of the Southeast Asia and China. So solving that underlying political problem in a way that was much easier for, if like, the IMF and the World Bank, where there was domination by the Cold War situation between the US and and Europe could be very hard. And a finally somewhat more speculative point that I'd like to put on the table, and it's actually related to the shoe throwing. I think there is a potentially dangerous area if there is a continued rise in insecurity amongst large groups of people, that what is now very much sort of a fringe radical resistance to globalism, anti-capitalism, will engage, which is a broader, what you might call collective primitive feelings, which some commentators see as very much as present in the United States. You could imagine rising in other countries and could lead to an alliance between that and what is loosely called, you call it populist if you like, call it, may translate into protectionist, and could lead to a more severe sort of undercutting of the process of global integration.
Thank you very much. Thank you all three, Dr. Shahrukh Khan, Bill Grimes, Michael Walton. I think you've put on the table a whole host of very interesting topics, but from our perspective, most importantly, I think you've already changed the debate into looking at global institutions and global architecture and what all of this means. Before I open it up for the audience, and we have a microphone, please do use it. It won't do anything to the volume of your sound, but you will be recorded in the video. But I wanted to see if any of you want to respond or build on any of the things that your colleagues have said. I see Sharikh's hand already going up.
Just one clarification, no elaborate.
Yeah, sure.
My colleagues' talks a great deal. I think the IMF has a multiple track in the kind of assistance it gave as an outcome of this crisis. And one track was a very easy facility, like the kind Poland got or Mexico got. But if you look at the letter of intent for Zambia, Uganda, Pakistan, Sri Lanka, it's much the same as before. So I really haven't seen very much difference in terms of the peanuts that were handed out. But yes, the big bucks came without conditions.
So the peanuts have conditions and the big bucks don't. Bill, do you want to take on?
Honestly, I think I went over by a few minutes. I'll just say that it feeds into the analysis that we all sort of think that it should. That there's a difference between a fundamental problem and a liquidity problem, and this time around they've been much more willing to to commit very large amounts of money to liquidity problems. It used to be that is based on how many multiples of your quota do you need, and the more multiples, the more conditions, regardless of whether we understood it to be a liquidity crisis or a structural one. I don't think very many people outside of Larry Summers thought that Thailand was a structural crisis, and if we'd had facilities for distinguishing that better in 1997, it wouldn't have been treated like one. But Zambia is still a structural crisis. Mm-hmm. Pakistan, I don't know about.
I also was intrigued. Am I hearing you right, all three of you, that the subtext, and in some cases actually the front text, is that the relative rise of Asia, as Michael put it, that out of this crisis, Asia comes looking stronger, and there might have been this rise happening before the crisis too, but it might have been an opportunity. Am I reading that right?
Yeah. In terms of leadership as well as in terms of economic activity.
Yeah. So a number of themes here. Let me open it up. The relative rise of Asia, the institutional architecture, the future of the IMF. Questions, comments, issues? Please raise your hand. We have a mic at the back. And Kevin? Kevin Gallagher from the Department of International Relations.
Thanks all of you for coming. I guess on that note, on the relative rise of Asia, we heard that Asia has become relatively better off or relatively recovered after this, and we also heard that some of the key players are in the G20 and they're pretty complacent in the G20. And what I didn't hear any of our speakers talk about is the debt overhang that we're going to have in the United States. I would agree that the one thing that we have been able to do is to put together a global package of $2 trillion to avoid the worst thing from happening. And the Asians did that by finance largely from the reserves, and we did it by going into more debt, borrowing more from the Asians. So we accentuated the fundamental global imbalance problem to be able to get us through the short term. And the long term, if you look at the long term, we're not saying that the IMF is going to turn into a global governance structure. We've got the G20 is somewhat of a global governance structure, but everybody is benefiting from the way it is, at least in the short term. So where does the impetus come from to really address the fundamental problem of global imbalances, especially in the context of the debt overhang in the United States? That's one question, and then another particular one for Bill Grimes. One of the real economy things that I'm the most concerned about for everyone outside of Asia from a development perspective is the decimation of innovation capabilities and endogenous technological capabilities in Latin America, Africa, and parts of South Asia. If you look at Mexico's recovery of the crisis, theirs was more L-shaped in 1994. They negotiated NAFTA when they were in pretty good shape. They had decent technological capabilities. Unfortunately, their crisis happened on the same day NAFTA was open. So their currency dropped at the same time there was free trade, and they lost a lot of their technological capabilities forever. And what can we learn from the East Asian V-shaped response for Mexico now and for Latin America and the rest of Africa?
Mm-hmm. Anyone? Bill, you want to go first on that?
Okay. Why don't I start by answering the question I'm really not qualified to answer, which is the one that you asked me directly. I don't know anything at all about Mexican innovation capability, but I know a little something about how East Asia has done it, which I think differs, and I think I can draw some places. So one of the things that is very clearly the case about most of East Asia, developing East Asia, to excuse low middle income in East Asia, has been that they've been willing to import other people's production. In other words, foreign direct investment has been a huge part outside of Northeast Asia, outside of China, Japan, Korea. You look at Southeast Asia, all of the growth in technological capability and productivity has been through foreign direct investment. Hasn't been through OEM primarily, as it was in Korea. It hasn't been through domestic, innovation and adaptation, as it was in Japan. It's been through FDI. And what has made Southeast Asia an attractive place for foreign direct investment? It has made it stay one, even as the cost curve has gone up. That's, I think, the question that the way that I would have posed it, if I were asking myself the question. And a lot of it has to do with the fact you have better governance, and you have better educated populations in those countries, and a willingness to accept foreign direct investment and export-oriented growth as the major engines of growth. So I think that Mexico looks a lot different from Thailand in terms of the human capital, I think. And I'm sure that Uruguay and Bolivia do. So I don't know if that answers the question, but it's the best I can do.
Anything else, Mike?
My reaction to the debt point, which I think is really important, is first there are big medium-term questions, which I'm sure is that there's been surprising resilience in China and India, and a surprisingly fast recovery. I suspect largely because of the short-run monetary and fiscal measures, but the burden of debt is going to be around for the next 10 years. That raises the question, in terms of a global source of growth, can Asia substitute for that? If you just look at the numbers, if you do the numbers and China and India and the rest of East Asia continue growing in the 8 to 12% range, it can. At the margin, they're much poorer, but when you're growing that fast, there can be a substitution. Now, can they do that in terms of the changing the pattern of production in China and sustaining the dynamism of India, I think is a really open question. And I feel very agnostic about that and somewhat worried. The next question that this leads to, which is even more speculative, if it is true that for the next 10 to 20 years a successful scenario involves this big shift, what does that mean for global governance? And I like the way we've gone that area, and I just don't know the answer. In fact, is it going to be really difficult, absent a resolution of an institutional basis in a number of areas, finance, trade, property rights, with Asia at the center? Absent that, will this lead to kind of conflicts and failures that we don't yet fully understand? And I think it's a really interesting question.
Can I add just one quick thing on this global governance issue and the debt overhang? Essentially, what you're asking is, what is the possibility for ongoing macroeconomic policy coordination? I think the G20 is a great thing, but I think we also need to be aware of how extremely limited this is. And let me just put out a blanket statement, which feel free to attack, but I think I'm 100% right on this. With the exception of the European Union, I can't think of a single case of effective macroeconomic policy coordination on an ongoing basis outside of a crisis that did not involve hegemony. Not a single one. Not a single one. And I see no reason to believe that the G20 is going to be the way in which China and the United States create the first known instance of this outside of the European Union.
That's a fairly provocative and strong statement. I'm wondering, so is the G20 the end not just of the G7 but of the G20? Is this a blip that we will remember 20 years from now as the moment when this architecture
Do you remember the C20?
goes away? I remember, I work on the G77. Right? So I know all the Gs. Gee whiz, is what I say. But I do want to probe all three of you. Is because this is a very interesting notion that Bill has thrown out there, that this could be the moment of disintegration. We have been hearing from Asia, partly because all three of you work on that, but we haven't heard about Latin America and Africa, and that's another rift that might come in if the locus of governance shifts Asiawards. And Shahrukh, I wanted to sort of see if I could probe you, because sort of you had suggested you had all suggested that IMF is different in this crisis and post this crisis. But is that because it's the last spark of an institution about to wither away, or is this the rebirth and regrowth of the age of IMF?
It's a bit hard to
Sure.
to say. I think it's been partially successful. I mean, mustering 500 billion was no mean achievement. The G7 clearly fully endorsed it, as did the G20, but there are some differences. And as I said, Germany was not very comfortable with the role the IMF wants to assume. So I think there are sovereignty issues and issues of mandate. Strauss-Kahn, I think, is not really withstanding the core IF model. I think he has been very effective in endorsing Keynesianism, and that was very surprising when he did. But I don't think he can take on his own economists, the core team. I don't see that at the nitty-gritty level. Certainly, the 50 billion committed to Mexico and the 48 billion committed to Poland, something like that. That two tracking
explanation that it's him who explains it, not the IMF.
I think that you see there is this tension of how we want to see the world develop, and that hasn't been resolved. There isn't any consensus, and I think that is what we're going to see sharpen. This notion of what was called the neoliberal model and alternatives, one of which I mentioned emerged from East Asian, Southeast Asian experience, and has been now more formalized than it was when people were just observing that experience and saying, this is not a liberal model, and there's something else going on here. So I think that competition of ideas will continue, and IMF's role, I think, is attached to that.
Other questions? We have a question up here, if we can get the mic.
Thank you, Ginny Griman. I enjoyed all of your comments and
From the law school.
from the law faculty and Metropolitan College, so I cut across two faculties. I would like to address this to all of you. I have two quick comments. One is infrastructure development, you've mentioned, is very key, and my question is, how are we going to attract private investment to infrastructure development when the World Bank, among other banks, call for high leverage on development? And you talked about low leverage because banks are not willing to take risk. And without high leverage, how will we be sure that our private investors will be willing to take risks in these low-income and medium-income countries? That's the first question. Shall I go with my second one? My second one is on regulation, and I could not agree more with your comments about our inadequate regulatory financial process. It surprised me when everyone was surprised that AIG had failed, because as we well know in this country, we do not have insurance regulation, at least at the federal level, and it is regulated at the state level by a private nonprofit organization. So I was just wondering what your thoughts were on regulation in terms of the very important insurance sector to our economy.
Michael?
On your last, I just don't know anything about regulation of insurance. But let me work backward. No, let me say I have a general view that what is needed in terms of regulation of finance is to actually have a regulation that makes finance more like the utilities, to make it duller, to make it less innovative, which will, but, and here is the important trick related to your first question, provide the incentive so it is good practice not only to do their core business, but actually to take on long-term investment in a number of areas. So you'd want to encourage to have a regulatory framework that was supportive for taking kind of the project risks that are in infrastructure, definitely supportive of venture capital, but would stop and would curtail, and I don't know exactly how you do that, but would actually repress other kinds of innovation, including repressing, and again, I don't know exactly how you do that, the absurd salaries. This is, I think, related to the other question that's on the table, which is how do you get endogenous innovative capacity? Because you want your best talent not going into finance. You want your best talent going into other areas. And partly, I think, part of the India story is that for a variety of reasons, the best talent went into industry. Finance wasn't attractive. There was a load of engineers. There were some ways of combining it. And so that did happen in India. Not, I think, through any particular conscious design of the Indian. The other comment I'd make on infrastructure is, and this actually relates to a question I have on a point that Shahrukh faced. I don't see a big problem on the capital scarcity side in terms of infrastructure finance. I see the much bigger constraints as solving the domestic political and regulatory risk. And I actually think if you can solve that, you would actually have a lot of project finance going in there. And if you didn't solve that, you wouldn't want it going there. Because what we've seen from the Latin American experience is where that was roughly solved, which was Chile, they actually, they basically eliminated their infrastructure deficit. Yes, there were excess profits. Yes, there was corruption, but it was minor. It was second order. In the rest of Latin America, they did not solve that. But it wasn't because of lack of capital. It's because of the risk problems and the problems of variously money getting siphoned out of the country or the private companies able to game the system through renegotiation. So I actually see that as an area where the global issue is actually very much a domestic issue and has to be solved there.
Any other thoughts on the infrastructure point? Because as was noted, one of the interesting things is actually how many stimulus programs there are and how different they are. And in my area of work, for example, sort of the greenness of the various stimulus packages varies very much. And China, it seems, is very much looking at a stimulus program that's structurally very different from the US one, it seems to me.
I think whenever I answer a question that I don't really know the answer to, I always go back to first principles. But there's three ways in which you can fund public infrastructure. One is by government spending, which means in practice in these areas, the ability to better mobilize local funds, whether by improving or expanding taxation, which, as you were saying, is a political problem. I think that might have been one of the political problems he was thinking of. Or by having some other form of captive means of getting a hold of savings. And here I'm thinking of the Japanese experience with this massive postal savings system, which has long since become wildly inefficient, but was extremely important for a while. A second way in which you can do it is by through property rights. Basically allowing private companies to to create monopolies and build it. The U.S. utility model. And then the third. And these have both been tried in various degrees, and they each have their own costs and benefits. And there's a third issue which is now being, I think, pushed at least in Asia, and I don't know to the extent it is outside the world, is the idea of the public-private partnership, which has essentially the characteristics, I don't want to scare anybody, of a collateralized debt obligation, where you have, you put a bunch of money in from different sources, you have an income stream that comes out, and you chop it up based on the risk. And then the government takes or the Turnpike Authority or whatever takes the biggest risk, and you can get a lot of private money coming in, but with a relatively low guaranteed rate of return. And so the extent to which any of these can be practiced, I'm sure, is going to differ on the ground somewhat. By the way, in terms of regulation, it's a disaster, I agree. And the U.S. is not going to remedy regulatory fragmentation. The best you can hope for is some sort of clarity.
Right, thank you.
Regulatory clarity is a good thing, if it does happen, yes. We have about 10 more minutes. If we have others in the room that might have a question? At the back?
This is just kind of a general, broad, overarching question, and I guess I sort of view the whole crisis as a risk exposure problem. And I'm wondering if you see the sort of movement towards globalization and of the economy as sort of the great pooler of risk and spreading the risk around evenly, or do you see that as sort of the great increasing other countries' exposure to risk because there's such information asymmetries, and I don't know. That's just kind of a general question. I'm wondering what you think.
That's actually a great question. What does it mean to the poor who will always lose, that they have to now pay for Adil Najam's bad mortgage decisions too because they're in a globalized world, or does it mean that in a globalized world actually there are others who will give safety nets for these global processes? Any thoughts? Everyone is looking at you, Bill.
Okay, I'm wondering, I have this analogy playing in my brain, and if it's a bad one, please just ignore it. But imagine, one of the classic problems of globalization is one we haven't talked about today, which is sickness. Okay, so imagine the swine flu or avian flu moving around the world. Exposure to the avian flu is obviously a very bad thing. On the other hand, there's a lot of other things that'll kill you, right? And poverty has got to be up there at the top. And so, if we can't come up, I don't think, with a single country that has grown rapidly in the post-war period while being autarkic. And that means that that it's not a question of there are ways in which what you have to do is take the profits from that can be achieved through globalization. Not always are, but can be achieved, and apply them to the losers. And in the end, it comes out as a political problem, which is not something that can only be stated in terms of national governments. Some countries have done a really good job with it. A lot of countries have done a really bad job with it. And as a political scientist, I keep thinking there's probably an answer, but I haven't come across it yet. But somehow the best thing that we can do as an international community is to push for better governance and better coordinated governance and better understanding.
After you've told us we are about to come into a period of governance chaos.
I was talking about macroeconomic
Yes,
policy
you're right.
coordination,
Michael.
not avian flu.
Yeah. Got three reactions, and I agree it's a very good way of framing it. First, I agree that global integration is going to be central to what all developing countries need to raise for innovation, advance, whatever. Second, that the onus has to be on the country itself in the form and manner of that integration, given that I would actually be pessimistic that there will be any international arrangement that will successfully collectively manage risk. And that needs to be thought through a lot more, including, as we know from the East Asian crisis, the way in which they opened, especially on finance, and how that was central to the genesis and fallout of the crisis. Thirdly, I think, just to expand a little bit on a remark in part of my initial presentation, I think that there is an extremely powerful case for thinking through what is meant by a comprehensive, equitable, and efficient risk management system for households and firms in a society, and that partly to solve political problems, it's crucial that is done ex ante, not in a crisis. If you do it in a crisis, it is true that is almost systematically inequitable. If you build it out of crisis, and two good examples I have there, one is not to do with globalization, is that, in fact, if you look at India, the biggest problems for the poor are typically not the macro crisis, it's typically drought. Now, India, for a number of important political reasons, introduced the most comprehensive system for social security for the poor that's ever been attempted at that level of income. It's a public works, the National Rural Employment Guarantee Scheme. It's still in the implementation phase, lots of problems, but when this year's drought hit, that I was going to say I did argue, but I wasn't part of the political scene. I wrote my strong view, which I wrote in a column, was that should be, India was extraordinarily fortunate that it had 3 years of experience. It should pile resources in to make it work. Part of that should be including the social audit so the money didn't get siphoned away. And that is, I think that's a powerful metaphor for what should be done in broad social security systems. The same applies to how you think of the financial system and how you think of firms. Bankruptcy legislation was introduced in the US, I understand, according to Raghu Rajan and Luigi Zingales, partly to solve the problem that you want to have an ex-ante commitment for loss allocations, because if you have an ex-post commitment, the most powerful do it. Same applies in the financial system. You need to have a commitment, and this is actually one of the things that is being talked about financial mechanisms of, what do they call them?
Living wills.
Living wills. So that, but there are two elements to that. One, that financial firms commit to how they will die when they run into problems, and you solve the market power issue so you don't have the too big to fail or the too connected to fail. And that is a market structure issue. And that is where the US seems to have failed, and I would see India as highly vulnerable, both in the public sector and it has huge private and huge public sector banks. And that has to be fixed in the market creation, market structuring phase.
Sharon?
I think I agree with both views. Ultimately, I would say the Maharashtra scheme actually predates.
Yes, it does.
Yeah.
Absolutely.
So they have almost 20 years of experience, 3 at the national level. But,
Yes.
But it goes way back in terms of risk management. I think that most countries now do realize that globalization presents a great deal of opportunities. It's a question of how they manage. And that does end up being at the country level. I don't think that. And so it really, I don't know of any social science that has an answer to that. Why it works and when it works. What makes it gel in terms of leadership? Because ultimately, I think the population does respond. I think, in fact, I visited China this summer, and I was amazed at the administrative capacity. Walked in, and those people, I first went to Pakistan, which is where I'm from, and it said, if you have coming from a swine flu country, please report to the Ministry of Health. Right, I'm going to go. In China, they took my temperature on the plane. And my wife's temperature was too high, so they quarantined her immediately, and they did some further checks, and found out that it was a cold. On the way to the hotel, she sneezed. The taxi driver puts all 4 windows down immediately. She goes to the hotel, and she buys some medicine, and she can't read the Chinese, so she asks the receptionist. He immediately reports to a doctor, who comes in and takes the temperature again. I mean, the point is, there's amazing, but everybody's pulling to a national project. And what I see around me in Pakistan is people are not identifying with the leadership. I mean, collective action won't happen until people feel that they have a stake. And what makes that happen is in a sense, it's intangible. It's hard to.
This is wonderful. We are running out of time. Let me ask an unfair question. I know it's an unfair, and I'm even going to make it more unfair by asking you to be short. But if you put your long-term binoculars on, does the climate for international global development look better, worse, or the same once we've floated through this crisis, whatever way we float? Do we have better institutions, worse institutions? Or is it, 5 years from now, this is over and we are back where we are and just muddling along as we were?
Well, I think the leadership.
I'll ask each one of you.
I know President Obama got a Nobel Prize because I think he's trying to change the way things are done in terms of multilateralism, in terms of global collective action. Whether you look at it at a micro level in Burma or Iran or Korea, he's saying we should talk. And I think that's great leadership. And it may change in 8 years, or it may change in 4, who knows. But I think that gives me some hope. That the leadership does eventually fall to the more prosperous. I won't say rich because they may not necessarily be culturally rich, but yeah, the more prosperous, the higher income countries. Yeah.
Word of hope on.
Yeah.
Well, I mean, I shouldn't be commenting on the way that the IMF and the World Bank and the development institutions work. Let me say that I think that one of the big causes for hope is that, particularly looking at Asia, starting with East Asia, but now I think increasingly moving towards India and hopefully maybe to Pakistan as well, and maybe parts of Africa, Latin America, is that we do know that the governance is really important, and that there are elements of governance that are important both to the functioning of the economy as an economy, which is attractive to the elites, and to the needs of the poor. And if we're thinking about as a long-term change in mind, a long-term mind shift in the way in which development is managed at the national and international level, I mean, my greatest hope is that we now have more and more models that seem to work and that may be adapted to places, and places that are seeking to, some places that are seeking to adapt these models are doing so in a successful way. So that's the best I can do.
That is very good. Change and hope, who can argue with it on the day that Barack Obama is named for the Nobel Award? That seems perfectly right.
Okay, on balance, I'd say much better, in the sense that the crisis both showed the necessity for international coordination. Because it was so extreme a crisis, there was a largely informal resolution of the short-run issues that showed it could be done. It was, at the same time, it showed the BRICS were brought in, and that was, I think, substantially accelerated because of the crisis. And I think, at the same time, the crisis showed for especially the major Asian countries, but also other, and the BRICS, that maybe something...
Maybe the BICS.
Maybe the BICS, yeah, actually it is. Including him. That something needs to be done that is not just about getting them a seat at the table, but in the next 10 years, next 20 years, they will not be able to rely on the existing hegemonic system in terms of managing the global situation.
Thank you very much, all three of our guests. I must confess, especially that those last answers, I like the optimism and hope, but I must also confess I'm surprised by it, but very pleasantly so, that we might actually have learned some lessons here and in the future might actually have some good. I just want to take this opportunity to thank our three guests again for being here, to thank all of you for coming here. We have these little gifts which I'll give to each one of you, our little black box. To remember us by, but I wanted one last time for everyone to thank our guests for being here and giving us a wonderful event. Thank you very much.